It's almost 11 in the morning in Hong Kong and Singapore. Welcome to Bloomberg Markets Asia. I'm David Ingles. Let's get to your top stories today. The Asian equity benchmark holding on to some mild gains, boosted by what's happening in Tokyo and Japan there. Most markets across the region trading sideways. Meanwhile, the Hang Seng China Index is poised to enter a technical correction. All that, of course, ahead of Fed Chair Jay Powell's testimony to Congress. Also ahead, we're talking TSMC in the U.S. ADRs briefly surpassed $1 trillion in market cap after that surge on a Morgan Stanley upgrade ahead of the company's earnings. Plus, President Biden pushes to end Democratic infighting over his White House campaign, telling lawmakers and donors he's determined to stay in the race. Welcome to the show, and hope you're all well as we move into, of course, the mid-morning some parts of Asia. Of course, some markets are coming online, like Thailand, of course, India. Ahead of all that, Avril Hong is with us in Singapore to give us a pulse check of these markets at this point in time. Avril.
Yeah, David, we're seeing Asia stocks, some of them taking a bit higher. It's a bit of a mixed bag. Certainly, if you look at Japanese equities, they're the ones that are outperforming today. And it is, I think, tracking that rally on Wall Street where the S&P 500 managed to clock yet another record close, and supported, of course, by the tech names. NVIDIA was a big standout performer after it got an upgrade from UBS on its price target. That's fueling some gains among its suppliers in this part of the world. But we are seeing a bit of pressure on the TAIEX, TSMC experiencing a bit of a pullback, perhaps not surprising given how we've been seeing it in overbought levels, right? The Chinese stocks, I think, are also a particular focus today. We're watching out for the close on the Hang Seng China. I think 62.60 is the level to watch to see whether it is in correction. But of course, this week, the focus is going to be quite squarely still on what Powell says, whether he gives investors anything to chew on, anything dovish to kind of bring optimism out for support for equities. Now, the Asia currencies, I think, are also keeping a close eye on what Powell has to say. For now, we're seeing dollar China ticking higher. It was the highest fix from the PBOC, I think, in 4 days. But of course, when it comes to the PBOC, this week has really been about how it introduced that new tool and how it is, perhaps controlling the shorter end of rates. Let's let the board take a look as that repurchase operation was added just a day ago. That really spooked bond markets. We saw that heavy sell-off today. It seems like, based on some of the articles in the Shanghai Securities News, that this is more geared towards addressing liquidity as it does bond trading, and also perhaps also raising the expectation of how the 7-day repurchase rate is going to be the new benchmark. Today, we're seeing a bit of recovery in the bond space. Let's flip the board and just recap, also put things into further context for you, because yesterday on the 1 year, we did see a move of about 10 basis points, biggest move in 6 months. And of course, this new tool has a narrower band compared to the existing corridor, David.
Yeah, in fact, Avril, just on that point, I think we got a report based on some sourcing we have in China. The primary dealers, they are able to submit demand here to the PBOC for the Tuesday afternoon session of these reverse repos. So we'll get you guys more on that, of course, that story. Avril, of course, will be sticking around. We'll discuss really what the PBOC is trying to do here and more with Mitchell Kotecha, who joins us right now, also out of Singapore. He's head of FX and EM Macro Strategy Asia at Barclays. Mitchell, as always, a pleasure to speak with you, sir. Avril mentioned, of course, we're looking ahead to Jay Powell. There's a dovish-shaped door, and he could walk through that. Is he going to walk through that door today, Mitchell?
You're right, David. I mean, he's got potentially the option to do that. The data has been softening around the edges. We had the payroll revisions last week. ISM manufacturing and services coming in weak as well in contraction. So clearly there is some softening around the edges in US data. We don't think it's enough to justify a significantly dovish outlook. We think Jay Powell will probably highlight some of the downside risks to growth that are opening up, but we think growth is moving back towards trend rather than anything else. But at the same time, inflation is still somewhat sticky, and that last mile of disinflation is also something he may highlight risks. So I think it's balancing the risks of softer growth with higher inflation, and in the end, it's going to be hard to sound too dovish. We think it's still in line with our view of a September rate cut or potentially December, but certainly nothing more than that at this point in time.
What's that September cut going to look like for the dollar then, especially as we see a bit of safe haven demand given the geopolitics of it all, Mitchell?
Yeah, Avril, I think the dollar itself has lost some steam in the last week, and perhaps the data has added to that pressure on the dollar. We think any dollar downside is going to be very temporary. We think it's going to give better opportunities to go short some of the low yielders certainly in Asia and other EMs, and certainly likes of Swissy, etc., even the euro. So we don't think that this dollar move is going to extend much further. The market's already pricing in around 2 cuts by end of this year. So if the Fed cuts in September, it's not going to come as a major shock at this point in time. And U.S. economy, in our view, is still going to outperform, and we think the Fed has less room to cut than some other major central banks. So all in all, that to us points still for a firmer dollar in the months ahead.
And as we move closer towards November, what's your sense of the net impact from tariffs on the greenback? I mean, is it more because of safe haven demand, or is it more because of what this is going to mean for inflation?
I think a bit of both. I mean, look, if we look back at what happened in the first round of tariffs in 2018, dollar rose significantly that year, and the CNY fell significantly as well. And I think, firstly, we don't know if we're really going to see tariffs. But if we do see a Trump 2 administration, and if that Trump 2 administration brings in 60% tariffs against China, 10% tariffs against the rest of the world, we think that's dollar bullish. And we could see at least an average 3% depreciation of the trade-weighted yuan, as well as broad dollar strength against a number of major currencies.
What do you think the PBOC's move in the past day then looks like in that context? Is it just biding its time until the Fed moves?
Yeah, look, I think dollar CNY, the RMB has been weakening on a gradual basis against the dollar through this year, really. If we look, you can draw a straight line from the beginning of this year to where we've gone, and it looks like the path is still for dollar CNY to move higher. And I don't think that changes. It's that gradual depreciation is continuing. The CFETs, a trade-weighted yuan, is still very much in the middle of its range. Our view is, though, we think the yuan will continue to remain under pressure in the months ahead. We expect to see depreciation on a trade-weighted basis as well. So generally some catch-up of the yuan against some of the weakness in other currencies, especially as China tries to maintain some export competitiveness. But any big move in the currency, any sharp depreciation may only take place if there are tariffs implemented.
And Mittal, just to follow up on that, I mean, the PBOC is trying to, has several objectives. Some on the surface appear to contradict each other, but I just want to get your take on the latest move that they're doing this week to, at least on the short end of the curve, trying to narrow the corridor there. And at the long end, of course, we know, of course, they've been building up inventory in case they need to intervene in the markets. I mean, is this yield curve control in the making? What do you make of what's going on there?
Well, and look, I think it's interesting that the PBOC has for some time been warning about the drop in yields, and I think they're worried about financial risks because of that, and over heavy positioning. If there is some sort of pressure on bonds, that could reverse and cause some pressure on banks and the financial system. So I think that's partly related to this. Of course, there's also another factor here that the lower Chinese bond yields go, the more pressure the yuan comes under, and the harder it is to control that pressure. So I think there's an element as well of trying to prevent a sharp depreciation of the Chinese currency. But overall, look, I think this can only work to a limited extent. Chinese growth continues to remain under pressure. Deflation risks are continuing as well. And when you have exports remaining the key engine of growth for China, it seems unlikely that they're going to succeed too much in maintaining or trying to prevent yields from moving lower. We've seen heavy buying of CGBs, continued depressed rates, and I think that's going to continue to be the case. We still look for yields to move lower.
Right, and Mitchell, to your point, right, if we are headed into a softer patch globally on growth overall, that pillar of growth goes away somewhat when it comes to exports in China. Do you have any expectations coming through? Next week is the third plenum. If not then, what more do you think we need to see to shore up growth and confidence in this economy, you feel?
Well, I think firstly on the third plenum, we don't have any real high expectation of anything happening or developing on that front. I think it's going to be very high level in nature. We're not expecting to see any big demand side measures being announced. And this is the point, really, that China, in our view, needs to push on the demand side. A lot of the measures to boost growth in the last several months have been very supply side orientated, and demand side continues to remain under pressure. So if we see maybe fiscal transfers, some sort of development of the social security system, some sense that they can try and boost demand domestically, maybe trying to improve labor market prospects, which have continued to weaken, that could certainly help. And of course, the elephant in the room here is obviously the housing market. Recent measures, there were some optimism that could help the housing market, but in our view, it's too little to really turn housing market sentiment. You need to see a big move to try and get rid of the unsold inventory in housing to really boost consumer balance sheets. And, we're far from that. So unfortunately, it's unlikely we're going to see any of that soon.
And I guess to your point, any tweak to monetary policy would just be pushing on a string, right?
Correct.
Not bring demand back up. But what is your sense of, given how it's controlling things in the short and the long end of the curve for the PBOC, is it going the way of Japan in a way?
There's been certainly plenty of comparisons in that respect. I'm not necessarily sure that we're seeing this as yield curve control for China, but I think at the same time, if China's really worried on growth, they're going to keep yields depressed. But as we've seen from the PBOC, they're actually worried about yields moving too quickly, too much lower. So they're not necessarily even trying to do that. So I think at this point that what they're doing in terms of yield curve, what they're doing in terms of bonds generally, it's more about financial risks in our view, and the fact that they're trying to prevent some sort of overweight positioning in the bond market that could result in a blow up further down the line.
Mittal, just to broaden the view across the rest of the region, I mean, we have a rate decision this week in Korea. Maybe they won't move this week, consensus at least. But it seems the narrative is on Korea, maybe Thailand, maybe the Philippines, is we could get a cut over the next few meetings at some point. Do you think that's generally a logical thing to expect?
Yeah, look, I think a lot of central banks in Asia are still waiting for the Fed. And if we're right that the Fed cuts in September, then it will start opening the door for easing. We don't expect any central bank really to move too quickly. Perhaps the Philippines may be the first central bank in the region to cut rates, and that could even come towards the end of the summer. But for example, Korea, we continue to expect a rate cut in October and potentially another one even in November from the Bank of Korea. But again, very shallow easing cycles expected in this region. Most central banks haven't had to hike rates as aggressively as, say, Latin America. Real rates have not been as high. Inflation has not been such a problem. So any easing in policy will probably be very gradual and very shallow. And we think a lot of central banks are still going to wait for the Fed before they start moving in that direction because of potentially consequent FX risks should they cut earlier than the Fed.
Mittal, what are your thoughts on the BOJ? Because it is meeting with bond market participants today and tomorrow, I believe. Are we going to see that reduction in bond purchase along with a rate hike at the end of the month?
That's our view. We do think the Bank of Japan will move at the end of this month. We think that the inflation picture has certainly moved in that direction, that it gives them enough ammunition to tighten policy. And we also think generally the growth picture remains fairly robust. Wages are another factor that's moved in the right direction. The real question for us is, does it have a big impact on dollar yen? And for now, it looks like dollar yen risks are still very much on the upside. A hike by Bank of Japan now is increasingly being priced. It's not fully priced. But unless you see the Fed cut rates significantly, which is not our view, then it's very difficult to see dollar yen to move significantly lower from here.
Mittal, fantastic to speak with you, sir, as always. Mittal Kotecha there out of Barclays in Singapore for us. Just ahead here on Bloomberg Markets Asia, we're looking at small caps, and really this group has outperformed. NAV Capital joins us to discuss that specific strategy. Micro and small cap plays in India. That's certainly amid concerns that it's a market segment that might be too hot to handle. Where do you go as far as exposure is at this point in time? But ahead of that, though, President Biden doubles down on his White House bid as more Democrats privately say they want him to step aside. Details ahead. This is Bloomberg.
bottom line here is that we're not going anywhere. I am not going anywhere. I wouldn't be running if I didn't absolutely believe that I am the best candidate to beat Donald Trump in 2024.
And that was U.S. President Biden. They're pushing back on calls for him to quit the presidential race. Now, of course, the president has been seeking to quell infighting, particularly certainly among Democrats, about his presidential campaign, writing a letter to lawmakers and telling donors he's determined to actually stay in it. John Herskovitz, our East Asia government editor, has the details for us on. Yeah, let's start there because this seems to be a fairly fluid developing story, John. Just get us up to speed. What is the latest here?
Okay, so far on Monday in Washington, we've had that appearance that you had of Biden on MSNBC. It was an unscheduled appearance. We have this letter that Biden sent saying that he's going to stay in the race. And also Biden's been speaking to donors. He was also supposed to have a call with the leaders of the Congressional Black Caucus Monday night Washington. I'm not sure if that's taken place or not. But this is all a fresh effort, a new push to quell this fighting within the Democratic Party and show that Biden is, with Biden saying that he's fully committed to the race, and he's trying to do this on a number of fronts.
Yeah, and have we heard any response from House Democrats, though?
Yeah, we're hearing various things. We've had at least 9 House members saying they don't want him to run. We have the leadership in various conferences. The so-called squad of Alexandria Ocasio-Cortez and Ocasio-Cortez and other members have come to support of Biden. So it's a very difficult way to figure out who is going where. But we have those who are speaking publicly, those behind closed doors, and the worry is there. And the Democratic Party is trying to find a way forward, and Biden is pushing to saying that he is committed for this race and he's staying in.
And as far as donors go, I would imagine it's the same sort of conversations, although that is a separate camp, of course, that needs to be, whose concerns need to be allayed. What are we hearing as far as where the donors are? You know, I believe some of our reporters have been speaking with some top donors there.
Right. Bloomberg did a story talking to some of the donors, and there is a wait and see that they're sitting on the sidelines for this one, realizing that it's probably not best to come forward, but there's also planning, strategizing about how to go, about where to put the money, what to do if someone does emerge. And what we've seen, according to this Bloomberg reporting, is that donations have slowed down a bit. And this is as Trump's war chest is growing. So Biden has quite a lot of cash on hand, but he really needs more to keep this fight going, and you're not getting this full-fledged commitment from some of the biggest backers of the Democratic Party to put more money into the campaign. So they're waiting and seeing on the sidelines like a lot of us are. And Biden, in the MSNBC interview, said that he's not paying attention to the big donors. He's fine appealing to the grassroots, looking for small donations to keep him going. But of course, the presidential race in the U.S. is incredibly expensive, and these big donors are part of what drives the campaign.
John, final question now. So, I mean, any information is helpful at this point in time. The latest Bloomberg polling, what is it showing?
We had a polling since the debate by Bloomberg Morning Consult has showed that Biden is doing better in 7 battleground states, but he's still trailing Trump. And if these results were to hold, Trump would take the Electoral College and take the election. So there's been improvement, but the overall picture, if it stays where it is now, the polling suggests that the presidential race would be won by Trump, according to what's come out since the debate from Bloomberg and Morning Consult.
John, fantastic getting us up to speed on all those fronts. John Herskovitz, there, our East Asia government editor in Tokyo for us, where we are just in a lunch break, but coming out of it in about 10 minutes or so. So just a brief markets wrap is just ahead. This is Bloomberg. Welcome back. In case you missed it, the S&P 500 clocked in its 35th record high of the year, but brace for a potential correction. That's according to Morgan Stanley in the coming months at least. Mike Wilson told us more about where he is seeing risks in this red-hot U.S. equity market.
What worries me is that momentum is so strong and people have a lot more exposure to high multiple stocks than they think they do. And if you have an event that's unpredictable, then you could have a real reset on valuation of 10, 15%. Like, I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period and it's going to be choppy. Now we're hoping that's going to create some opportunity, but like right here, valuations to me look very, very unexciting.
And it's a great point, too, on you might be more exposed to tech than you think, especially if you're sitting in the S&P 500, which is, what, 30% tech or so. I do want to actually talk about how all of this rolls into price targets. And typically at this point, I would ask you what your year-end S&P 500 forecast is. But I know that you've backed away from those sorts of calls. And it was interesting. If you take a look at Friday, we got some news from Piper Sandler saying that they're actually going to drop their S&P 500 forecasts, that basically it's bad practice. And when you think about that, I mean, are we starting to see the beginning of the end of these big, bold S&P 500 forecasts? Well,
no. What we do is we rolled forward our forecast 12 months in May, so we take away our year-end target. And look, first thing I would say is S&P targets at a certain time and price is kind of silly. But what I would tell you is that the risk-reward from here we think is lower. Like over the next 4 to 6 months, for the same reason I just mentioned, we have volatility probably picking up in the third quarter. I would say your likelihood of upside between now and year-end is very low, much lower than normal. I'd call it 20-25% that markets are higher between now and year-end. Okay, specific target, I don't know, but let's say it's down 10% or so. Then we would get interested. Then we'd be interested to say, okay, maybe there's some things happening at the index level. Where the opportunity remains is at the stock level, at the factor level, okay? And in that regard, we still like sort of growth, but not just quality growth, but like, quality in general, large cap, good balance sheets, companies that can deliver on earnings, and that momentum will continue. It's just hard to find companies that are cheap. So if they were to come in 10%, then we'd probably get interested again.
And that was Mike Wilson there, the chief U.S. equity strategist at Morgan Stanley, speaking, by the way, the debut of Bloomberg's Open Interest, a new offering, of course, on Bloomberg Television. Right, a couple of things we're tracking here as far as markets go. Apple suppliers, there's a story that Microsoft has told its employees in China that from September they need to be switching to, well, they'll only be able to use iPhones at work. That's the story there. We're seeing, as you can see, some upside there. I'm wondering, though, I'm wondering whether this is NVIDIA move we're seeing, a related move, or does Microsoft have that many employees in China to move the needle? Anyway, that are not iPhone users already. Anyway, Hong Kong IPOs very quickly. We have a couple on deck today, and as you can see, how do I describe this? Varying levels of downside today here in the city as we approach the last 30 minutes of the morning session, Tuesday session here in Hong Kong. Plenty more ahead. This is Bloomberg. Right, welcome back to shows. We are just going into the lunch break over there onshore in China. CSI 300 down a 6-day. It's worth noting that volumes are on the lighter side of things today, so maybe not a lot of conviction. Although that being said, the direction has been very clear. Lack of momentum there. In fact, some of these technical indicators are indicating that this market is oversold, but it has been oversold on many occasions over the last few weeks or so, which basically tells you we're hitting lower and lower lows on the CSI 300. Right, on the benchmark basis, though, you pull back and we're looking at Hong Kong last 30 minutes of trade, so we look at the CSI 300. We are now coming off lows of the day. I think we were down as much as 1% roughly on the Hang Seng China Index. Still, though, at about these levels, we're still on track to enter a technical correction here in Hong Kong, slightly weaker, as you can see there on dollar China. Right, away from these markets and looking at Tokyo, which is coming out of its lunch break. Avril Hong is looking at that market for us. Avril, what do you have?
Yeah, we're seeing that outperformance in Japan, almost as if we see the selling in China that's going towards equities in Tokyo, and the Nikkei is reaching yet another record. Quite stellar gains since the start of the year. Today, the fuels are from the tech-related names, the semiconductor stocks, and this is tracking the performance of NVIDIA overnight after it got that upgrade from UBS. These are the big boosts to not just the Nikkei, but the topics as well. And of course, all eyes are going to be on what Powell says, whether he gives a bit more for the markets on the dovish front of things. Let's flip the board and take a look at what we're seeing cross assets, because at play is not just about the Fed, it's also about where the BOJ goes from here. I think that given we're seeing that two-day meeting from the BOJ with bond market participants, the expectation on consensus seems to be that the reduction in bond purchases at the end of the month can come along with a rate hike, and that the BOJ talking to bond market players seems to be a way to guide it, that it's cautiously going to be cutting back on these bond purchases regardless. That's going to be bearish for bond markets, though we're seeing some of a reprieve, a bit of a climb on Japanese bonds. And on the yen, still on the back foot, we're still around the 161 level against the greenback. Of course, this is about the yield divergence, David.
Absolutely. Avril, thank you for that setup. In fact, that's the perfect segue to bring in Mark Cudmore out of our MLive team. He is, of course, executive editor there. He's been taking a closer look at this, this vicious cycle, and Japan finds itself in, a falling currency, maybe a stagnant economy. You've been looking at this. Tell us more.
Yeah, absolutely. It's a stagnant economy pretty much for most of the last 30 years. And again, this year, in fact, consensus forecasts on Bloomberg predict that the economy this year will only grow 0.3%. That's the slowest of any major economy in the world. It's slower than most non-major economies in the world. Again, the Japanese economy is lagging behind. And that's despite the fact that Japan has deeply negative real yields. So even with deeply negative real yields, i.e. very supportive monetary policy, it can't generate growth. Ultimately, that means there's an economy which is suffering from the fact that it's got a legacy of keeping zombie corporates alive, which are inefficient, and this very, very large government debt pile, which is now, we're seeing the bill come due for those two problems. And it is the currency that will continue to pay it. And that's why the yen has depreciated so much in the last couple of years, and why the yen overall is still set for a long-term decline, even from here. Of course, if you get the BOJ hike rates this month, or other periods where you get a sudden boost in policy support, you'll have intermittent bouts of yen appreciation. But note that there'll be the blips, there'll be the temporary rallies in a depreciating trend. And there's also, of course, for dollar yen, the Fed plays a very important part. But the idea of yen, whether it keeps on falling on the crosses, that will remain the case until Japan can generate proper growth. And that probably comes when the currency falls so far that it really gets a major boost for its export industry. We're just not seeing that sufficiently yet. And that's why people use real effective exchange rates, which tend to have a look-back period, to say that, oh, yen has fallen way too far. They're going to continue being wrong on this trade, because ultimately the yen, yes, it's fallen a long way. It can fall a lot more over the coming years, even though there will be intermittent bounce of strength when the BOJ tightens policy or when the MOF comes in to intervene.
Yeah, but to your point, Mark, those are extremely small measures. The analogy I always like to use is, half an Advil after 3 bottles of tequila. Helpful, but maybe not. It's interesting we're talking about the nominal levels of the yen back to the levels of the 80s, because that went into the Plaza Accord. And to your point, if the yen needs to fall significantly more to make a difference economically as well. But by the time we get to that point, Mark, don't you think we'll be in a broader conversation about maybe needing another Plaza Accord if the yen falls another 50%? I'm just taking a figure out of my head here.
Yeah, I think if we do have an extreme level of depreciation again from here for the yen, and dollar strengthening, which might be applied on a trade-weighted index, then yes, I do think the conversation, another Plaza Accord, will come into the conversation. But we're still quite far away from that. I know you just plucked an arbitrary number, but I do think it's a significant decline for me. I don't think 5% more in dollar yen makes a difference. I don't think it matters we're at 170, 175, 180. Those kind of levels aren't enough to change this. I think another part of the dynamic here is, though, it's really important important to separate the yen long-term trade, which remains very negative, versus dollar yen. Now, the two have aligned in the last couple of years because we've been in a dollar strengthening cycle. But if we do get to a scenario where the Fed starts cutting rates, or we start getting concerned about the US fiscal situation because both parties in the US presidential race support more kind of fiscal expansion, well, then we could see the dollar peak out. And that might mean that dollar yen stops going so far, which means that on a trade-weighted basis, yen stops doing quite so badly. But it will still continue suffering on the crosses. Just because dollar yen stops going up doesn't mean the yen is not depreciating. It just means it's slowing the pace of depreciation. Remember, Japan's largest trade partner by miles is China. And the yuan-yen move has been really incredible in the last 5 years.
Yeah, I guess your point there too, you know, the economic relevance of Japan from a broader point of view, dollar yen, but there's also the yen. I mean, you make this very good observation, Mark, that, you know, Germany is now bigger than Japan, and it surpassed Japan in a year that the economy actually shrunk in Germany. And before we know it, India is about to overtake Japan as well. Just give us more context there.
Yeah, it is pretty incredible that Germany's economy contracted last year, and yet it still surpassed Japan. Why does that? How did that work? Well, it's because in dollar terms, the yen currency weakened so much versus the euro. So overall, Germany's output to the world economy grew bigger just because the euro became so much more valuable than the yen. And you make this point, it was only in 2010, it's quite incredible to believe, it was only in 2010 that China surpassed Japan to become the world's second largest economy. It's now more than 4 times the size. So it shows just how rapidly that can change. That's in 15 years, that kind of pace. And it's the same thing that's going to happen to India in the next few years, and it will leave it behind for a long time to come. And I think, unfortunately for Japan, not only do they have these zombie corporates and, you know, just an ability to generate growth, but they have this real demographic problem. So that's why this is a new paradigm for Japan. It's not a blip. We're not returning to the old world. Unfortunately, Japan is going to left in fighting that stagnation, and it'll ultimately be passed out by other countries like Brazil in the coming decade or so as well.
Fantastic. Mark Hudmore there, our MLive executive editor in Singapore for us. Let's just, there's no easy way to pivot here. So from the yen, let's turn to Taiwan right now. So in case you missed it, so overnight, you had a massive rally in TSMC shares that were traded in the U.S. You take a step back, and this AI trade's really front and center, if you will, and you look at our consensus, well, the consensus rating on the stock of TSMC. So one would be an extremely bearish call from the street, which would be every single analyst would have a sell recommendation. A 5 would be the opposite, and we're almost at a perfect 5, with the exception, I think, of one analyst who has a hold in the stock. Every single one on the street says, buy this stock. With everything that you got. Well, I just added that last bit there. Let's have a look at the outlook for TSMC, though, given that fairly bullish backdrop with Annabelle, of course, who's been looking at this story. And, yeah, I mean, we're running out of superlatives here, Bill.
Yeah, that's right. And I was actually just taking a look at who's this lone person holding out with the hold rating. It's Krish Senka from TD Cowen. But anyway, yeah, there's 35 buys on this stock. And as you said, it's just so much optimism around AI that we're continuing to see across the board. And briefly, as you said, entering that $1 trillion market cap. But to note, of course, you've got the ADRs in focus. They do trade perhaps sometimes at a bit of a premium to the Taiwan listing, just given the accessibility issues sometimes for investors. But it really just has such a pole position in the AI race because it's the lone supplier of the most important chips to the likes of Apple, Nvidia. And so even when you've got geopolitical tensions that continue to just sort of simmer in the background, investors still want to own TSMC.
Yeah, what are the latest here as far as the revisions and price targets? What do we hear?
Well, yeah, so we had one overnight. Actually, I should have mentioned that Morgan Stanley has boosted their price target, so they're seeing around 9% further upside from their current one. But as you said, pretty much everyone is bullish on this stock. So we're heading into the earnings, the second quarter numbers. The expectation is we're going to see perhaps around a 35% jump in revenue on the year. We could also see a revision upward to revenue guidance. Important to note as well, perhaps not everyone is quite so optimistic on the AI trade as a whole. There's actually a note out from Citigroup earlier this morning saying that equity sentiment around artificial intelligence is now looking the most stretched going back to 2019. And so they're saying that investors should take profits in some of the high flyers in the space, notably the enablers like chips, rebalance toward perhaps a sort of a broader array of AI stocks across the value chain. So that's the call from Citigroup.
Now, let's stay on chips, but this is a different story, of course, that we're seeing over in Japan, for example.
Quite a different story, because you're seeing that big run-up that we've had on a lot of the chip names over the course of this year, and you saw those record highs around April, May. From that point onward, those stocks have sort of trended a little bit sideways. And one of the reasons being noted for this is just the amount of margin buying that we're seeing in Japan, and it's particularly coming through from retail investors. That chart there actually behind you, you're looking at buying positions that are going back to the levels that we haven't seen since 2006. So it points to that sort of optimism, but when you have that much margin buying, it does make it a little bit vulnerable, because if you see a bit of weakness, then investors might need to close out their positions, and that adds to further downbeat sentiment for those stocks.
Very quickly, is this just a chip story, or are there other sectors that are looking
you're seeing,
stretched?
most margin buying actually is on Tokyo Electron, which is the most out of the Topix 500, but it is pretty broad-based. And actually, to Citigroup's point about the value chain, Japan, of course, has a big part of the value chain for AI. It's not just about those names. It's also things like utilities, infrastructure providers. And so some of those names, for instance, Tokyo Electric Power, Hokkaido Electric Power, they've also seen more positions being added.
Belle, thank you so much. There we go. Okay, just ahead here, we're looking at small caps. NAV Capital shares their strategy for investing in this particular corner of the equity market. It's done extremely well. It's become extremely crowded. What do you do with that information? Vineet Arora joins us in a couple of minutes. Welcome back. You're watching Bloomberg Markets Asia, going into the India Open today, and we're looking at a little bit of upside there across some of these benchmarks. I was about to say weakness because of the color, but let's call it flat there. On the currency, right, to geopolitics now. So Bloomberg has learned that India and Russia will probably agree on a long-term uranium supply pact. That's as, of course, the Prime Minister Narendra Modi is visiting Moscow. Let's bring in our government reporter in Delhi, Sudhi Ranjan Sen, to take us through this potential deal and what we know about it, Sudhi.
Well, what we do know is that both sides in the negotiations in the run up to the visit were very, very close, and what we are being told from New Delhi that this is most likely to go through. Mind you, Russia has helped India in the past and is working with India to run civil nuclear power plants in the southern part of the country in Tamil Nadu. So what we're getting to hear is that there is going to be a long-term nuclear fuel supply agreement between India and Russia. Of late, we have seen prices of uranium going up as more countries, looking to transition into cleaner energies, looking at nuclear energy. So India trying to secure long-term supplies of fuel, and mostly for the nuclear power plant in Tamil Nadu. That's what we are getting to hear. We are also getting to hear that there are discussions that are going on fertilizer manufacturing. Mind you, India imports a lot of fertilizer. And apart from that, we can also expect to see a logistics supply agreement between the two militaries, which kind of helps the two militaries, the interoperability of the two militaries, which are very, very close and historically has been very, very, very close.
Yeah, we do have, I believe, one or possibly more bilateral meetings taking place today. Is there anything I should be paying attention to?
Well, interestingly, this is one thing that, is what the Indian sides have been flagging or is interesting as per the schedule that I see. Prime Minister is going to visit a pavilion of the Russian state-owned nuclear energy enterprise. India has plans to manufacture, set up more nuclear power plants for energy, and Russia is kind of trying to do a demo, so to say, of the kind of nuclear reactors that it has for India. It is not that India doesn't know or is completely alien to the kind of nuclear reactors that Russia can offer, but it's being displayed. Now that is very, 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 very significant if you look at what Russia is trying to project and message. So that's one thing that I would look out for, although I'm not expecting any major announcements from it. And also we can expect, as we are getting to hear, deals on fertilizer manufacturing and manufacturing between the two countries.
Sudhi Ranjan Sen, our government reporter in New Delhi for us. Now, staying in India, but back to markets right now. And our next guest founded a wealth management advisory company which actually looks at microcap investments, which, by the way, as a strategy has done extremely well. In fact, you could make the argument it's getting maybe too crowded. But is it? Let's put that question to Vineet Arora, MD at NAV Capital, who joins us right now. Vineet, good morning from Hong Kong, and hope you're well, sir. Thank you for joining us. I mean, small caps have done well. Well, basic question, can it continue given it's looking slightly overheated?
It is looking quite overheated, but I think it will continue to do well. For India to achieve its vision of $30 trillion economy by 2047, SME and the small caps are very, very critical because they are the backbone of the industry, the manufacturing sector in India. And government will continue to focus on that to take it to the next level. And especially in line with the current government's Make in India program, these SMEs or small companies or micro caps are extremely critical. If a Foxconn comes and sets up a large plant, you need these small entities to come along to set up the supply chain. So, we believe that is the way forward, and none of the large caps are born large caps, right? They all start as a small cap at some point and grow to large cap over the years.
Now, Vineet, sorry, I was going to mention as well, just as a housekeeping note, define small caps for us in an Indian context. What's the range we're looking at on market cap?
So typically, small caps are defined as less than $500-600 million market cap. And of course, then you can continue to define micro caps or nano caps. There are various definitions available. But typically, the way we look at it is anything from a $25-30 million market cap to $1 billion market cap is what we would focus on, what we would define as small caps.
And how is the liquidity in this part of the equity market?
Sometimes it could be a bit of a challenge. So you need to manage your positions effectively from that angle. If you want to buy a large position or sell a large position, you can't because that will impact the stock price. So you have to take that into consideration when you're building up your positions. So you have to do it gradually. You just can't go and buy, and that's always a challenge. That's why we kind of we try to do a lot of IPOs, pre-IPOs, and then stay invested and continue to build up positions into the listed space.
Right. Oh, okay. So you're getting in early as well. Well, since you mentioned it, give us an idea of what valuations look like pre-IPO, and also where you think that pipeline looks like. What does a pipeline look like for these small cap IPOs moving forward?
Pipeline is actually massive. The market has. If I look at the SME, which goes more towards a small cap, we had about 100 odd IPOs in 22, growing up to about 180 in 23. And so far this year, we've already had about 130 IPOs and with almost 200 in pipeline. So it's growing exponentially, the really micro cap space. And a lot of these companies have actually moved to the main board from the SME exchange. Even if you look at the main board IPOs, we've had over close to 40 IPOs so far this year. And the size of the IPOs has increased both in the SME space and the main board space. The average ticket in the SME has grown from about $2 million of IPO to about $4 million now. The quality of companies have gone up. Similarly, if you look at the main board, if you remove LIC from 22, your average ticket size has gone up from about $120 odd million to close to $170-180 million. And removing the big IPOs from the number. So we've seen the size of the IPOs increasing. Along with this, we've seen a lot of existing companies who've been coming out with the follow-on issues or preferential issues or QIPs or what we call qualified institutional placements. So a lot of capital is being raised. What has fundamentally changed in the market is the retail investors in India. We had about 20 million investors into markets, which has grown to about 150 million from 2020 to 24. So that's been exponential growth considering, 1947 to 2020, we reached a number of 20 million, and that's grown by 7 times in the last 4 years. So there's a lot of money coming into the market from the retail investors.
So things are good, Vineet. That's the sales pitch. What's the risk that most people don't see?
Most of the investors who've come into the market have not seen a bear market, and I always worry, what will happen if the market turns around, because they're all boom time investors. So I think that's a big risk. There's a bit of frenzy going on. Everybody just wants to jump into the next IPO, and people think that everything is going to make money. So there's a lot of over exuberance, I would say, some froth in the market, especially in the micro cap, small cap space. One needs to be very, very wary about, one needs to look at the quality of the promoter, their background, needs to do a thorough checks on the company. It's not as simple as it sounds because the data points are very, very sparse in this segment. Unlike a large cap where thousands of analysts are tracking it and you've got a lot of data points, in small caps, the data points are not available, the stocks are not tracked. So you need to do a lot more due diligence before you get in as compared to large caps. But that's where you find the multi-bag.
Yeah, risk reward, isn't it? Underscored hashtag. Well, we have someone like you to look at this space for us. Vineet, fantastic. Thank you so much. Let's do this again. Run it back. Vineet Arora, MD of NAV Capital. Right. Plenty more ahead. This is Bloomberg.